So now what I'm going to do is I'm going to hand it over to Andrew. Thank you.
Thanks, Brett. Okay, just before I get started on this, the way we're going to do the demo today, I'm going to go through about 20 minutes or so of slides just to give a little background on risk theory and what have you, and then we'll also go into the product itself. So the first 20 minutes we'll try and set the stage and give a background of the risk theory in general and how it relates to the projects you'd be working on. Then we'll go into the product itself, and we'll show you kind of how to navigate the tool just a wee bit, and then also go through a lot of the outputs that you'll be able to get from the risk tool as well. So as we're going through this, Brett mentioned as we're going through, please do, if you have a question along the way, type it in the chat menu. Brett will stop me and ask that question. We don't want to get on past the demo and not get all the questions answered as we go. We will save plenty of time at the end to do a question and answer session. So you know, when we're looking at risk management, there's kind of two ways to look at this, and risk is sometimes a dirty word for people. So when you look at why risk management, it's all these dirty words, and it's the ones that people look at over and over: the late deliveries, the over budgets, any of these liquidated damages, bad things that are going to happen. When we look at this, a lot of times there's a lot of kickback in terms of the word risk analysis. Well, we don't want to do this. There's no benefit. What are we getting from this? And what we'd like to do in terms of from a buy-in perspective is saying, you know, everything in planning and scheduling and estimating is a reactive science. So instead of looking at the concept of risk management, we kind of look at it as we're being proactive schedulers. We're proactive estimators. So whereas in a schedule, usually, you know, if we're a week behind, we're trying to catch up 1 week. Now, we're not looking a year down the road and realizing we're going to be 3 months behind. You know, if we look down the road and we realize we're going to be 3 months behind, I may be 2 weeks ahead right now, but I still need to be planning proactively that I'm going to be 3 months behind. If I don't start today trying to make up that time, I'm never going to be able to make it up when things do happen. So, you know, scheduling in project management in general is very reactive in nature. And what we're saying is, from this Monte Carlo or this risk analysis, all we're really trying to do is be proactive. And instead of saying we're a week ahead, don't worry about it, we're fine, we're saying, hey, you know, we've looked a year down the road, we're going to be 2 months behind, and we got to catch that up now. And what this process allows you to do, it's not really any extra work. What it forces you to do is doing things correctly. So it's going to force you into improving your schedule, making more accurate estimates, whether it's time, cost, man hours. The information flow has to improve by default. So, you know, we want to pinpoint our contingency dollars. We want to control those schedule slippages. We want to be proactive in terms of doing this. But these tools really are done in such a way where it's not, oh, it's all this extra work and there's no benefit. It really forces you to do things correctly. So, you know, a lot of times it's not harder to do things correctly. You just need to be pushed in the correct direction. So, in terms of the methodology behind what we're going to go over today, this isn't something we just made up. This is a very common methodology, very standard methodology on some of the largest project management organizations. So if you look at PMI's process overviews, if you look at the AACE's process overviews, go to the UK and look at the APM. All of these guides have a very similar process. And a huge benefit of this Primavera risk tool, or the Oracle Risk Analysis tool, is you have the ability to take these risk events, items that you didn't plan for in the scope, you may have just in an Excel spreadsheet, and you don't even know if they're going to happen or not. Something like a contract delay or a permitting issue, things you didn't plan for, but if they happen, they're going to have an impact on your schedule. Generally speaking, these risks are held separately. And what this is going to allow us to do is tie those in and really make them a living, breathing part of the estimate or the schedule. So going through this, this is a methodology that's focused on by all of the major project management organizations. Just to give a couple key terms off the bat, one is Monte Carlo analysis. You'll hear the buzzword Monte Carlo analysis all the time. All a Monte Carlo analysis is a probabilistic simulation. It's something that we do and run over and over and over so we can see a trend curve develop. So if anybody goes on like an ESPN.com, they simulate basketball games or football games. They put in a bunch of factors on the game and they run it over and over again until they can decide what they think the scores are going to be. You see it in funeral service companies will do a Monte Carlo on death rates based on various factors for that year. Insurance company have lots of historical data, and they're doing the same thing on death rates or car accident rates. They run these simulations over and over again, and based on running this probabilistic information, the trend curve really should provide a view of reality. So we're taking that same concept and we're applying it to an estimate or a schedule. So we'll put some when we come up with our schedule, we may say, hey, we thought it was 20 days. We can put some variability around that then, and then when we run that simulation, we can really get a feel for what our schedule is going to do in realistic conditions. So all we're really trying to do is simulate reality. A word I may say quite a few times is a three-point estimate. A lot of times when we're looking at a single point estimate, that would be what was in our schedule or what was in our estimate. We said it's going to be 20 days. That's a single point estimate. It's a single value. That's our best guess. Often when we're looking at probabilistic information, we're looking at three-point estimates. So that would be a best case, your single point, your original estimate, and a worst case. So a minimum, a maximum, and a most likely estimate, which is very common for putting variability on, whether it's costs, the man hours, durations, etc. So what we'll do is take some of these three-point estimates, we'll put them onto the schedule, and then we'll run a simulation where our bars move around, our costs change, and we'll be able to develop confidence levels of hitting certain schedule dates based on that probabilistic data running over and over again. So we'll see that trend curve develop, and the trend curve will be relative to our project schedule or our project estimate. The last buzzword I'll go over is a risk register. Seeing as though this is a risk demo, I'm sure a lot of you already realize what a risk register is. But all it is a list of risks, as much or as little information as you really want to track. The key, though, relative to doing a schedule risk analysis is when we bring something into a schedule, cost, probability, and duration can all hit the schedule. If you think about these risk events, items in a risk register really are activities in a schedule. They're just probabilistic, so they may happen or they may not. So when we model these risks in, they'll become a living, breathing part of the schedule. They get converted into schedule activities, with the main differences they have a probability of occurrence. So if I say, hey, it's a 100-day risk item, that's going to hit the schedule somewhere. But when we run the simulations, maybe there's only a 10% chance that those risks occur. That's basically what we're doing. We're just scheduling. We're just putting in probabilistic values. One of the things that we'll compare it to oftentimes is, when I drive to work here in the morning, there's a 20% chance any day that there's going to be a car accident, and that's going to push me an hour out. That would be a risk event. I don't even know if it's going to happen or not. I didn't plan for it in my drive to work or my scope of work. Really, I planned for 45 minutes to an hour. However, if that car accident does happen, I've got a big problem. The analysis may be slightly different at different phases of your project. So if you're looking at a tender or a bid level schedule, you're going to do things slightly different from an execution level. You're going to have less information up front. During an execution level, hopefully your scope is going to be set. You'll probably have a better grasp on how long things should take, but you'll start seeing more risk events. So even though it may be slightly different, the sizes of the schedule may be different, a pre-bid schedule may be smaller with less detailed logic, it's still the same type of analysis. This is the type of product that you can and should be using throughout the life cycle of your project to manage risk. A lot of the users that we see actually using this project are at the project level. So estimators, schedulers are probably the biggest users of the project, risk departments. But from a higher level, portfolio managers as well. You can do the same type of analysis from a portfolio level and run 20 high-level projects through this and get a feel for the cash flow on all your projects. And hopefully that data is able to flow upwards. And really, as I mentioned earlier, because this tool forces you to do certain things correctly, the flow of information improves by default. When you bring this in and use this on an ongoing basis, you really have no choice but to have better quality data. And it really isn't, it isn't harder to do it. A lot of times it's just making sure you're doing the right thing off the bat and continuing to do that. So just an overview of the benefits. As I said, the schedule maturity is a huge thing. Oftentimes just because schedulers are scarce in the industry right now, going through and oftentimes schedulers are overburdened. Sometimes the schedulers aren't bad schedulers, they're just overworked. They don't have time to maybe make every tie properly or do some of this work properly. This really helps and speeds up the time for cleaning up a schedule and making sure that it's a quality schedule. And that's going to be beneficial for anything you do. The schedule is the basis for so many things that we do. If we're doing earned value calculations, if we're doing risk work, it just updating and managing the schedule. So it's a huge benefit. But schedule maturity is very important in doing this, because if you're making a probabilistic simulation of the schedule, obviously you want the schedule to reflect reality. A massive benefit of the Primavera risk tool is being able to take that risk register in. These risk events that normally sit in an Excel spreadsheet. It's unfortunate that oftentimes there's a silo between risk registers and the schedule. So we may have put in an Excel spreadsheet all our schedule risks, but if we don't integrate them with the schedule, we have no idea what they do to the schedule. And obviously that's a huge problem and a huge disconnect. How are you going to tell me what the schedule risks are when you have no actual idea what the impact will be on that schedule? A 30-day risk event can be much different in terms of impact depending on where the float is in the schedule and where the other risks are located in choke points in the schedule. So this really helps you identify where those risks are and what the impact is, seeing where those risk hotspots are. And instead of, uh-oh, now we've been reactive with this whole process, we're 2 months behind, we better throw money everywhere, buyers are burning, we panic. Really what this allows you to do is proactively up front locate those risk hotspots and try to mitigate them before they become those giant fires and everyone's running around screaming. So looking at our risk exposure, once again, risk exposure is when you're looking at a cost point of view, a lot of times people will look just, the cost times the schedule impact, running the simulations through this. The Monte Carlo from a cost point of view, it adds another level of maturity to that. But from a schedule point of view, it's quite impossible to do that without taking these risks in and seeing how the float in the schedule is eaten up, seeing how the bars move, seeing how the logic dictates the schedule moving out. Really difficult to say what your schedule risk exposure is without doing that. And beyond that, it's really hard to determine what your cost risk exposure is without having any concept of what your schedule risk exposure is. You'll see oftentimes when someone does a cost risk analysis, they'll say, oh, we're going to be 10% over budget. They do a schedule risk analysis and they say, hey, it looks like 8 months late. Well, if you know 8 months isn't $1 million and it's more like 10 million, you're saying entirely different things. So when you don't have the ability to see what that schedule component does, it's really hard to do any type of cost analysis as well. So what we're looking at doing is really making sure our contingency values are correct, seeing how far we're going to miss our schedule by, and the purpose of that is not just to give bad news to people. We use the tool to give solutions. I always say, you know, you're in big trouble if you're reporting bad news. But if you're reporting solutions, that's when you're more of a hero. So we'll go through how to get those numbers out, how to look at the contingency values. But when those values are unacceptable, we've got to be able to use this data to bring our schedule back in line with expectations. So I may say, based on what we're doing now, we're going to be 3 months late, and that's bad news. However, if we do A, B, and C proactively, we're going to eat that 3 months back. And if you want to eat 4 months back, maybe we bring on another contractor. I can give you options and solutions to put that project in line with your expectations. Then we can start doing that cost-benefit analysis of mitigation, of fast-tracking activities, etc. In terms of an integration point of view, the PermMaster tool or the Primavera Risk tool, it integrates with all the major scheduling tools in the industry, as well as major risk register databases as well. So if you're on some of the legacy tools like Primavera P3.1, up through their newest versions, P7, Microsoft Project, the different versions, 2003, 2007, Server, Deltex Open Plan, it will integrate with all of those. So if you've got contractors that are giving you schedules and different things, or you've got certain projects using different tools, the data is all going to come into Primavera Risk flawlessly. And that's a huge benefit because oftentimes there's issues converting from one file type to another. But since this risk tool, it really thrives on being able to bring in data from different sources. It's actually a great translation tool. So if I brought a project in from Microsoft Project, it can really convert it to P3 flawlessly, which is a very difficult thing to do elsewhere. So in terms of just a flat conversion tool, it's fantastic. One key concept, and this is what we'll talk about a lot in terms of how to properly model risk, we look at the idea of uncertainty and external risk or risk events. When I say external risk, I'm looking at something external to the schedule, external to the scope of activities that we actually put in the schedule. When I look at uncertainty, I'm saying, you know what, we put that in the schedule, and we put it at a certain duration or cost, but there's some variability around it. So if I said, hey, you know what, we're going to demo a building. We put it in at 20 days, but we know it's 15 to 25 days. Or like my drive to work. I said, you know what, I think it's about 50 minutes, but it's really 45 minutes to an hour. That's my uncertainty to the work. Now, there may be a lot of little risk events. I could model in every stop sign or stoplight as a risk event. But normally that's my uncertainty. It's all those little risks that really go into like a productivity factor, a little fudge factor in the work. When you're looking at risk events or external risks, that's normally what's in your risk register. And a key indicator as to whether it's a risk event is, can you put a % chance of occurrence to it? If I say we're demoing a building, what's the chance we're demoing that building? No, it's 100%. We scheduled that work. We're doing the work. It's 100%. There's some variability on the duration, though. When I look at something like a permitting issue, or, hey, we found asbestos in the building and we're going to have to do all sorts of, that would be a risk event, something I don't know if it's going to happen or not. We didn't plan for that. You know, we planned for the permit to go through on time. But now as we're going through, we realize, oh, there's a 30% chance that permit doesn't come through and there's a month delay. That's my risk event. I can put a probability on that. And because I can put a probability on that, what it does statistically it just becomes part of my schedule. It's just like an activity. That that permitting issue, it's a 30-day activity. But when I run simulations, that activity realizes, oh, I only happen 30% of the time. So when I run that simulation 1,000 times, it'll take into account 30% of the time that ran. So I'll be able to see the impact that risk had on me, even though it didn't occur every time the schedule ran. Just so people can visualize what that actually does, if you see this green bar here, if my demolition was 15 to 25 days, it goes in that green point right there. That red area would be, oh, you know what? It's still going to take 15 to 25 days to demo the building. However, I may start at 30 days late. From a schedule point of view, if you're thinking in terms of what does the bars look like, I can put these finished to start. Maybe the permitting issue should be first here. But basically what I've got is, hey, the building demolition is 15 to 25 days. However, if the building demolition takes 25 days, the permit takes 30, the absolute maximum is 55 days. However, only 15 to 25 days is the actual work. The rest of that is risk event. And what you see normally in risk analyses is you'll see people say, oh, man, well, I'm not looking at external risk, the building demolition, I've got a bunch of gut feel risks, a permitting issue, all sorts of things. You know what? I know we could finish it in 15 days, but it could be as much as 55 days. So they put these huge spreads of risk on there. But because they didn't account for the probability of that risk, statistically they skew the model, and the data gets very corrupted because they haven't modeled the risk properly. Just to give you an idea what the charts of the two look like, on the left, using PerpMaster or Primavera Risk, I'm able to model those probabilities in. It's 15 to 25 days of work, so you get a bimodal spike there, one at 70% of the time, the other 30%. On the other one, if I say, well, it's 15 to 55 days, theoretical minimum and maximum are exactly the same. But the problem is you've skewed your data. So just because you've modeled risk incorrectly, at a 50% confidence level, you're already 11 days off. It's very hard to model risk properly in other tools because of that. This gives you the ability to statistically easily model it, but also correctly model it. I'll go over what these charts mean in just a moment when we open the product, but it's really giving me my confidence level. And these charts show me, when I look at it, there's an 11-day difference between modeling it correctly and incorrectly. If you do that 10 times over the course of your project, you've already skewed your data 100 days out, and you can't account for it. And all you can do at that point is fudge data. You've lost traceability, you've lost statistical accuracy, and that's why it's so common for people to fudge data. What's great about this tool is if you look at these drivers in the bottom left and bottom right, this also shows me on the bottom left, my permit issue is the big deal. So a lot of times people will show their schedule drivers and they might just, demolition will show very big, and they say, hey, that's not an issue. That doesn't make any sense. It doesn't weave the story that you're trying to sell behind why the project should finish late. In the example on the left, because I put those risks in, I have traceability now. So instead of someone saying the answer is wrong, they can see why the answer is right. Or if they really believe the answer is wrong, I have enough traceability to find out why the inputs are wrong. I always say my answer is never wrong, but my inputs are sometimes wrong. The answers just do what the inputs tell them to. But when you lose that traceability, and it happens in so many other tools, having that risk register separately, it allows you the flexibility and the traceability to really fine-tune your data and make sure you have an accurate model, and it makes it easy. You can do other things like weather models. You'll see similar things for oftentimes political models, union models, where if you're working in other countries, maybe due to the labor there, you might have strikes and outages. All sorts of things like that can be modeled in the tool, and they have quick templates and interfaces to do that as well. So as we go through, and I'll pop open the tool in just a moment, we'll take about a 15-20 minute spin through the tool, and I do want to leave a good at least 10 to 15 minutes for questions at the end. This is a standalone scheduling engine. It is a fantastic scheduling engine, and actually was a scheduling tool for 20 years before it was ever a risk tool. There's so much schedule maturity functionality because schedule maturity is so important for being able to do a Monte Carlo analysis. So from a scheduling tool point of view, a lot of people have bought this tool simply to schedule. There are advanced schedule checks. Your P6s and things like that do have some schedule check functionality, but this is very fine-tuned at being able to do a proper schedule risk analysis. It's also very easy to navigate. They're web-based reports that are sortable, so if you've got contractors or you've got a scheduling department and you run all your schedules through this, if you run these through on a constant basis, you can kick the reports back to a scheduler. If you keep doing this as you go through the life cycle of your project, you normally don't get those huge problems with schedule that you'll see oftentimes when this type of thing is ignored. There's some overlap with other tools that do schedule checks, but this actually goes at an extra step. You have a risk register that you're able to tie into the schedule as well. So I can say, what happens if I do have a contract delay? If normally you can't link that into the schedule to run the analysis, it gives me the ability to merge that with the schedule and say, hey, you know what does this really do to me? We'll go over the confidence level histograms and your tornado charts when we open the product, but what they are at the end of the day, when you look at a confidence level histogram, people use it to determine contingency or how far they're going to be behind at a certain confidence level. If I'm 80% confident, I look and say, I ran this, and 80% of the time I finished on or before a certain date. So if you want me to be 80% confident, and maybe in this example I need 105 extra days. This is always, if you look at it real simply, where am I at? What does it look like right now? If you want me to be 80% confident, hey, I need an extra 105 days. That's always bad news. So when you tell me, Andrew, 105 days, unacceptable, I'm actually going to fire you at that point. So figure something out. This is how to fix it. Tornado charts are, you've got your where am I at. This is your list of drivers. If I'm 105 days late on my simulation and I'm 80% confident, these are the big guys that pushed me out there. So instead of throwing money everywhere to try and figure out how to get that 105 days back, I want to look at these guys, and these are the ones. These are my choke points, my hot spots. And if I can start putting money on each of these, if I can mitigate some of these, that's how I'm going to most effectively bring my schedule back in line. So if I report I'm going to be 105 days late, however, this is where I'd say, hey, if you'll put money here, here, and here, I can save you that 105 days. I've got a proactive plan to save you that 105 days. So 105 days is reality if we do nothing. However, if you look at these charts and analyze it, I think we can do A, B, and C and save the day. One of the things that we often do then is follow S-curves back, and I can show scenarios side by side, like the schedule on the left here. You can see, oh, I've got two scenarios side by side. The scenario on the left saved me 170 days. So I can say, you know what? I came up with a plan. It's $1 million, but it'll save you 170 days. Is it worth it? And you get into that cost-benefit analysis. So you can put curves of anything you could think of beside each other, man hours, cost, schedule, but it allows you to play what-if games. So when we're doing these analyses, it's real easy for people to understand what an S-curve is. And they can start saying, what if? What if we put money here? What if we get a second crew here? What if we work an extra shift? What if we work nights? And any what if they can possibly say, you can show that curve. And it's real quick. It's real easy to play those what ifs. So you say, hey, what if we double shift everything? I run an analysis, show you a curve. Hey, it saves us 50 days. Oh, great. Okay, what if we do this? And you play it like a science experiment where you do one thing at a time and slowly work your project back in line and come up with a mitigation. instead of wasting money by throwing it everywhere. So there are some more charts, some probabilistic cash flows, resource flows, man hours, and scatter graphs as well. So if anyone does have cost-loaded schedules, the schedule will drive the cost. So anything loaded with man hours or daily rates, the schedule is going to drive that cost. If you have discrete costs like materials and things like that, any costs you have on your schedules, or even if you just have an estimate of discrete costs, we can run cost charts on that as well. So, Brett, what I'm going to do is switch to the product now. I think we're running pretty well on time, but if there's any questions, this would be a great point to interject them. So.
Okay, right now I don't see any questions. If anybody has any questions, once again, you can go to the question area within GoToMeeting and just type your questions in, and I'll ask Andrew the questions.
So what I want to do now, I know we have about 25 minutes left. I just want to show you some of the key features of the tool. Those familiar with P6 or Microsoft Project or any scheduling tool, you're going to get a very familiar look with this. For those who are estimators possibly, you can also see it from more of an estimate point of view where you just have cost values. For this demo, we'll focus mostly on the schedule portion. First thing I wanted to show you is the schedule check functionality, because the way this does the schedule check, it's a fantastic tool as far as being a collaborative tool, also as far as passing this to contractors. I ran a schedule check on this particular schedule. It puts us in a web-based format. All these links are clickable. I can pass this to anyone to be able to clean that schedule up. So while P6 or Microsoft Project is still going to be your main repository for your schedule, you can get this data back, and it really, if you clean this up on an ongoing basis, you can stop those huge flaws that sometimes hit bigger schedules on the back end. It does check for some things in different ways than some other tools. You'll notice as I go through here, it's very sortable as well. So it gives me the ability to really dig in and find where those issues are with my schedule, but in a nice user-friendly format, not a dump of data that comes in Notepad or something where it's hard to even dig through the data. This is presenting it in a nice fashion and showing you, hey, you know what, if you really want to do this stuff, whatever it is you're doing, earn value, risk, this should be cleaned up. As it goes through as well, when we run these the schedule checks, you'll notice it bookmarks activities. And the reason it's such a great collaborative tool is oftentimes when people are running and trying to clean up the schedule, they'll use these bookmarks and they'll be able to quickly see where the problems are with the schedule. It also makes columns for where these flaws are in the schedule so you can run filters. So if you don't know if something's a problem or not, it allows you to find it real quickly and validate it before you clean it up in P6. So schedule check functionality is huge. Monte Carlo in general is a great schedule validation tool. Those histograms and tornado charts that we showed you before, even from just a schedule point of view, they're a great cleanup tool because they tell you so much about what's going on in the network of activities. So to give you the quick version of what we do here, this is an engineering, procurement, construction schedule. It's just a 20-line schedule to give you a flavor for what we're doing. This is cost-loaded. I do have a risk register on here. You'll notice you've got your standard fields. All this information comes directly from Primavera. So, you know, your P6 schedules, if you've got them cost-loaded, anything else, any user-defined fields, activity codes, they all come right over. You don't have to do anything. There's a lot of ways to load risk, but one of the huge thing that this product does is allows you to load risk in a template fashion. So if I have some kind of method behind how I'm loading risk, a lot of times you hear people say, oh, everything in the schedule, I just put plus or minus 10% variability. You say, well, you did no due diligence. Whereas this helps you on larger schedules break things down. Right here I have it by risk level, high, mediums, and lows. I could do it by anything you could think of, but what's real popular now in industry is people are building templates based on their subcontractors' productivity or their area of the project or their discipline. Anything that they, activity codes, work breakdown structure, if they say, you know what, our concrete guys have a productivity factor that we track. Let's apply that to our risk analysis because it's data that we're actually tracking. You can create these templates, reuse them every month. Risk analyses become super fast at that point. And because you're organizing things in a way that the project team understands, you can get that ownership of the data to people on the project team as opposed to a risk person's head. So they don't need to know how to run a risk analysis if you say, hey, what's the productivity factor on concrete right now? If they know that information, they actually own the outputs because they're giving you the inputs. So you're speaking their language, you're bridging that gap. So that's a huge benefit. The other thing is being able to take this risk register in. The risk register, like I said, it's a list of risk. You can do all sorts of tracking with the risk tool, etc. But the huge thing is things like these key resource unavailable, contract delays. I've got my risks on the left, my schedule on the right, and I'm simply pointing, clicking, and linking things up. And what this allows me to do is take something like a contract delay that I only have a 60% chance of happening, or a system failure that has a 5% chance. And it merges with the schedule, and this contract delay now becomes a living, breathing part of my schedule. And that's huge now, because when I run the simulation, and I'll go ahead and run this through so people can get a feel for what it's doing. The bars are going to move around a bit, and hopefully this gives you some insight into what the Monte Carlo actually does. You'll notice, too, on the right-hand side, the cost is going to recalculate for me as well. And what's happening here, this risk is firing 60% of the time. I've got variable durations, and they're all recalculating. So what it does, right now I put in 2,000 simulations. It's actually calculating my network for me 2,000 times. So it's saying, you know what, I'm going to run this over and over. I'm going to recalculate the network every time. And when I'm done doing that, the outputs now are going to be that trend curve. Now I'm going to say, you know what, because I ran this 2,000 times and I tried to simulate reality a couple thousand times, I've got a pretty good feel for when I'm going to finish. So right now, I'm looking at an 80% confidence level. It looks like I'm going to be 268 days late, and maybe that's unacceptable, but at least that's my starting point. I'm trying to say, what is reality? Now I start playing those what-if games and saying, you know, well, we can't afford to finish 268 days late. We really need to find ways to get that data back in line. You can do the same thing from a cost point of view. So I can say, even though I had I had a 10% chance of hitting my schedule, about a 5% chance of hitting my cost. And I can do other things such as start dates and float values and durations. But this is telling me where I'm at. Then when I look at my tornado charts, my drivers, why is this happening to me? So I can see what's pushing me out there. So when I look at this chart, liquidated damages are having a huge impact on me. When I look at items such as my risk event here, the system failure, that's something where, wow, that could have a huge negative impact, even though there's only a 5% chance of it happening. A clean end strip out activity, maybe that's something where I can say, hey, we can put a second crew on that. So this is giving me insight into where to put my money. Then I can start playing scenario modeling games, and I can actually work this schedule backwards. And I've got an example of what we would generally do. From an executive point of view, this is always what we would show. We would say, you know what, we looked at this schedule, and there's our 268 days late. But we ran a scenario with some mitigations, and I saved you 172 days. I ran another scenario. We saved you another 68 days. by putting dollar values on these scenarios, then I can decide, what is the cost benefit of an analysis there? What do I need to do so those damages aren't hurting me? I can rerun the analysis. And really, the risk analyses so many times are unpopular because the data isn't traceable or you're reporting bad news. This is giving you the ability, you're not reporting bad news, you're reporting solutions. I know running as we are, it's not going to be good news, but I'm going to tell you how to fix it. Same thing from a cost point of view. I can show that same type of view. So I can show you how much you're going to save. If certain scenarios are more expensive, maybe we spent $10 million to mitigate, but it only saved us $5 million. This is the type of chart that will show you, hey, you're not putting your money in an effective fashion. And a lot of times when we model these things after the fact, we look and we say, you know what? People had done this. They would have known. They really were going to waste a lot of money. So once again, all we're doing is proactively scheduling. We're looking at the trends and how things are going to shake out, and we're trying to bring things back in line and manage it properly. So, when you're looking at scheduling as a reactive science, you've always got those fires to fight. When you're looking at it as more of a proactive point of view, if today I was a month ahead on my project, I probably wouldn't be panicking. But if I knew that a year from now I'm going to be, or 3 years from now I'm going to be 268 days, I'm already in panic mode. I'm already proactively trying to save that time back. Once it gets too late, you're not going to get those 268 days back. But if I know right now, hey, there's a chance I'm slipping 300 days, let's start planning this moment, because the only way we're not going to hit those liquidated damages is if we plan for that much slippage from day one. So that's what we're trying to do here. There are some other charts, such as these scatter plots. They show you the same type of confidence levels. They just take cost-loaded data, too. So I can say, you know what, I really want to see my % chance of hitting a budget and a schedule date. This shows me where each simulation landed. So there's 2,000 little dots in there. So if you don't have cost-loaded data, you don't need it to run this. The schedule will often give you good insight into where your costs are going to land. But if you do have cost-loaded data, it takes that data and it extrapolates out what your costs are going to be based on that. So, if you have an estimate only, no schedule, you can run an analysis. If you have a schedule only, no cost, you can run an analysis. If you do have a cost-loaded schedule, you can run things such as these probabilistic cash flows and actually see where your money is going over time, see where your choke points, your over and under allocations of man hours. So, Brett, hopefully that was an okay view. We kind of sped through it a little, but I wanted to hit on the main functions of the tool. And really, the key is with the templates, the risk register, and all of these features, it makes things quick, easy, and traceable. But it helps you sell these reports, and it really, I mean, everyone here being project managers, if you're not proactive on this, it's real easy to get knocked off your pins. And once it's too late, there's only so much you can do. So Brett, I'm going to pass it over to you, and if you want to open up the phones, hopefully